So, what is the first thing that strikes your mind when I say time value of money? Or let me put this way. So, what is time value of money, and why are we reading money in conjunction with the terms like time value and then put together? Why are we stating it as time value of money? So, even before we get into the subject, I'll ask you a question. Say today I'm here and you are there, and I give you 100 rupees. I give you two options. One option being that either you take 100 rupees today, or either I give you 100 rupees 1 year down the line or 2 years down the line. Which one would you prefer? So, which one would you prefer would depend on number of factors. For example, what is the risk? So the first thing you ask me, what is the risk? So in other words, what is the guarantee that you will be giving me 100 rupees 1 year down the line or 2 years down the line? So the first thing, what would you ask me? What is the guarantee that you will give me 100 rupees 1 year down the line? And hence you would rather tell me, give me 100 rupees now. This is the first thing what you consider when I ask you a question. And the second thing would be the inflation. So what is an inflation? And inflation is the increase in the value or in the cost of the goods and services that are being produced in India. Now, you might say, so whatever I want to purchase with 100 rupees would not be the same 1 year down the line. And hence, you better give me 100 rupees today so that I can purchase something which I want today instead of trying to deferring it 1 year down the line, because I'm not sure how much would be the price down the line 1 year. So this can be due to any number of reasons. For example, it might be because of increase in input cost due to inflation, increase in product cost due to inflation. So the second thing you would ask me is, or probably the second reason what you would give me is the inflation. And the third important reason could be that investment opportunities. So what is an investment opportunity? Say, for example, you are a person who is fascinated with stock markets, and then you want to buy a share with the amount what I give you today. So you're not sure what would be the price of that particular company or that particular stock 1 year down the line, and hence you would say, hey, give me 100 rupees today. It's well within my budget, and that's the reason I would rather take 100 rupees from you today instead of trying to go 1 year down the line and then buy the stock at a much higher price. And I'm not sure whether that would be well within my budget. And that would be one of the reasons what you can tell me to give me 100 rupees today instead of trying to deferring it to 1 year down the line. And the fourth important reason could be the preference for present consumption. That is to say, you have an important thing which needs to be purchased today and that cannot be deferred. So if I come and say you, hey, I want to give you 100 rupees. So you have two options in front of you. Either you take 100 rupees now, or either you take 100 rupees down the line, 1 year down the line, 2 years down the line. Now, if you have an emergency requirement, you would probably ask me 100 rupees, hey, you give me money today because I have something X or something Y to buy today. So I don't know what would be my need, 1 year down the line when you are ready to give me. So better give me today. So what is the reasons for time preference of money is these four predominant reasons. On the flip side, it can go the other way around as well. For example, risk. When I guarantee you through an agreement that I am bound to pay you so much amount 1 year down the line, you are pretty much assured that he is anyways bound to give by way of an agreement. So better I would take 100 rupees down the line when I actually have a need. Now, it could also be the second case where I'm talking about investment opportunity. Say, some good opportunity is going to rise 6 months down the line, 1 year down the line, where you're pretty much sure that you're going to get a best investment opportunity 6 months down the line. And you say, hey, instead of you giving me 100 rupees today, you give me 100 rupees down the line where I have a better opportunity. So I'm just trying to say the time preference for money depends predominantly on these four factors, and your SFM per se also would primarily deal with all these four chapters A culmination of these four reasons is what is the dissemination of all this SFM into 14 or 15 chapters what you have into. So all these four terms or even more beyond this is what you listen in and out of SFM every day. And this is what makes this subject fascinating. So let's get further. So what is time value of money? So time value of money is nothing but, put simply, 100 rupees today is not equal to 100 rupees 1 year down the line. So why am I saying this? I'll give you an example. I give you 100 rupees today and then you go and invest in it, invest in a investment opportunity that pays you 10% per annum. Now 100 rupees, if I have it with me and then retain it for one more year, that 100 rupees still remains 100 rupees. However, the 100 rupees, if I give it to you and you invest it somewhere which fetches an interest rate of 10% per annum, your 100 rupees is not equal to 100 rupees 1 year down the line. It's 110 rupees down the line. So 10% interest is pretty much sufficient to beat the inflation of 5% or 6% what has been in India in the past decade. So your 10% or your 100 rupees what I've given you today is pretty much higher or is much more than my 100 rupees. So my 100 rupees still remains 100 rupees, but the 100 rupees or the 110 rupees what you have received 1 year down the line is because of the investment opportunity that paid you 10% per annum. Now, this is what makes this interesting. So 100 rupees of mine 1 year down the line is not equal to 110 rupees of yours. This is the investment opportunity. So the reason why 100 rupees has turned into 110 is because of a better investment opportunity what you had and which I didn't have. Now, coming to the second important factor is the inflation. So what is inflation? Now, suppose 100 rupees what I have today, I can probably buy, say, a silk of 100 rupees. Now, 1 year down the line, the same silk is not going to cost 100 rupees. It probably is going to cost some 110 rupees or 120 rupees. Now, will I be able to purchase the same silk today, whatever is costing 100 rupees 1 year down the line with my same 100 rupees? If it is costing 10 rupees, so I mean to say, if it is costing 110 rupees 1 year down the line, I am 10 short of buying a silk. Whereas you getting an interest of 10% on your 100 rupees of investment are pretty much sufficient with your money to buy a silk 1 year down the line as well. And even today, you're able to buy the same silk for 100 rupees as well. So inflation and investment opportunities. So these two are the key things what we are going to discuss down the line when we are going with the further chapters going ahead. So these two are pretty much important, and then let's dig it the best possible. So now, what is the concept of simple interest and compound interest? So let's get started with simple interest. What is simple interest? Simple interest, as the term decides or the term defines, is the normal interest what is paid on the principal. So the 100 rupees invested in a bank, say you go and invest 100 rupees in an FD. Now you go 100 rupees and the rate of interest is 5%. So you get 100 rupees into 5% per annum into, that's for 1 year. So that is nothing but 100 is your principal, rate of interest is 5%, and the tenure is 1 year. So the math works really simple. 100 into 5% into 1, that is nothing but 105. Now, what would be the rate of interest for the second year? Now, the rate of interest would pretty much be 5%. But what differentiates simple interest from compound interest is the principle on which the interest is computed. So in the simple interest, the principal still remains the same of 100 rupees. So even for the second year, you are going to get the same 5 rupees as interest. And for third year, it's again the same old 5 rupees, what has been computed on the principal of 100 rupees. So this is the key factor, or this is the key differentiation between a simple interest and a compound interest. So how is compound interest computed then? So a compound interest is computed. This is an example which I'm going to discuss, within a couple of minutes. So even before that, so why is a time value of money? Why is the concept of time value of money needed? Now, first thing could be, so my argument for why the knowledge of time value is needed is arriving at the comparable value. So what is arriving at comparable value? So what do I mean to say? Or what exactly do I mean when I say arriving at a comparable value? So for example, 100 rupees today, like in the earlier example, is not equal to 100 rupees what I have 1 year down the line. Now, so how am I telling this? So I am only able to tell this because of the time value of money, the concept of time value of money, because you would come and say 1 year down the line, hey, you have given me 100 rupees 1 year back, and your 100 rupees is the same as what you had 1 year back. Whereas my 100 rupees, what you have given me a year earlier, has now turned into 110 rupees. So arriving at a comparable value is why the knowledge of time value is needed. Okay, so tomorrow you might come and crack a joke on me saying, hey, your 100 rupees is still the same, whereas I could turn my 100 rupees into 110 rupees. So this is the first reason why the knowledge of time value is needed. And the second reason is the capital budgeting. So capital budgeting plays a predominant role, or it's the vice versa. The time value of money plays a very critical role in capital budgeting. So what is capital budgeting? Capital budgeting is where you plan for a capex. You're not sure whether the capex would make you profitable or would it generate positive net cash flows down the year. So that's when your capital budgeting comes into play. So when you're going for a huge capex, this is when the organizations use capital budgeting. So what do we typically do in capital budgeting? So this is not something new to you, but just a quick recap. Capital budgeting is where you compare the present cash outflow with the present value of the net inflows. So how do we do this? Now that works simple. The math goes like this. You have the present value of capex. So that is nothing but how much you are going to incur for purchasing the capex, or you're going to incur for acquiring the capex. Now, how are you going to arrive at the future cash flows? Now, that goes on a concept, something called as project finance, wherein you estimate what is the profitability that is going to generate because of incurring this capex. Say, for example, 1 lakh is the capex what I'm incurring, and I expect my profit after tax to be 15,000 down the line for 10 more years. Now I'm going to get 15,000 per year for 10 more years. Now that's going to be 1,50,000. Now we are going to say, hey, you're putting 1 lakh and then you're getting 1,50,000. So there is a cash difference, or you're going to get 50,000 higher than what you're incurring. But is that how we are going to compare? No, that's not how we are going to compare. So how are you going to compare is where the time value of money comes into play. Now, as I told you earlier, 100 of earlier 100 today is not equal to 100 1 year down the line. Similarly, 15,000 today is not equal to 15,000 what I'm going to get in second year or in third year or in 15th year. The value of 15,000 is much less than the value of 15,000 what I'm having today when I stand in year one. So now for this, how do I compare? Now, then comes the concept of net present value. I'm going to discount the cash flows. So I'm going to have the sales figure. I'm going to arrive at the profit after tax amount, and I'm going to add back the depreciation, the non-cash expenses, and then I'm going to arrive at the cash flow. What am I going to arrive? I'm going to arrive at the cash flow for all the 15 years, the effective cash flow. And then this effective cash flow is discounted to the present value. So if I'm standing on year 0, all my cash flows are going to be discounted to year 0 using an interest rate. Now the next question comes, what is the interest rate? What is the most reliable interest rate? Now an interest rate can be three things. First thing can be your cost of capital. So when the management wants at least the cost of capital, the cost at which I am incurring the capex, the management is not going to have, say, 1 lakh if they want to incur the capex. So they'll have to incur or they'll have to borrow either by way of equity or either by way of debt. Now we are going to dig much deeper into equity and debt when we are going dealing with the relevant chapters. But just to give a quick recap of how the capital budgeting and the time value of money works. So they are going to borrow or they are going to raise funds. Now this comes at a cost. So raising money through equity or raising money through preference shares or raising money through debt or bank loans or whatever it is, everything comes at a cost. Now, when the management feels the cost of capital, the cost at which I am raising the funds should at least be met when I'm incurring the expenditure on this particular project. You take the cost of capital as the rate of interest rate. That would be the relevant interest rate when the management feels or intends that at least the cost of capital should be recovered. The second one could be an investment opportunity. For example, the management might say, I have two plans. One plan is incurring a capex and then getting some cash flows. And the second investment opportunity is, say, suppose I invest in some X mutual fund and that mutual fund guarantees me some 10 or 12% return. Now, so the management feels that I am getting a return, agreed by the mutual fund agency for 10 to 12%. Whereas in this particular capex, if I'm incurring 1 lakh, I am not sure whether the project would reap me 10 to 12%. Now, that is when the alternative investment opportunity, the interest of an alternative investment opportunity, or it is also called as opportunity cost in economics. So the opportunity cost comes into play. Now the opportunity cost here for the management is the 10 to 12% of interest, what the management is being assured of by the mutual fund agency. Now this 10 to 12% of the interest rate would be the basis for discounting your cash flows of 15,000 for the next 15 years. Now the third important interest rate is the IRR. Now IRR is something which we are going to deal with in depth when we are doing with capital budgeting. So IRR is the internal rate of return. That is what the management expects from the project. So when I'm going to say IRR is what the management wants. So IRR is the rate at which my outflows are equal to the inflows at bare minimum. Okay, so this is what is IRR. So we have a trial and error method. We either follow a trial and error method or an interpolation or an extrapolation method to arrive at the IRR. Now, this is the third interest rate which we follow for the capital budgeting. So all this, this had to be told because of the reason to just recapitulate why is the knowledge of time value of money needed. And the third reason why the time value of needed could be to identify the trade-off between present and future cash flows. That means to say, what would be the interest rate at which I am either going to be in a break-even point, that is no profit, no loss, or the interest rate at which I'm going to get a positive cash flow, or the interest rate at which I'm not supposed to, take up the project. That means to say when I'm getting a negative cash flows. So time value of money is needed when I want to identify either of the three opportunities. So this again comes as a part of capital budgeting. Now next comes the concept of compound interest and what is the concept of present and future value of money. So let's deal with this with a typical example. So here this is the simple interest column and this is the compound interest column. Okay, this is year 1, year 2, year 3, year 4 and so on. Now say for example 100 is the principal. So for example, you might be aware of the concept of annuity. Annuity is a periodical inflow or periodical outflow. So the periodical could be monthly, yearly, quarterly, daily, or whatever it is. So 100 here in this given example is amount, and the interest rate what I'm taking is to be 10% and the term is taken to be 5 years. So as I discussed earlier, what happens with simple interest is the principal remains the same on which the interest is computed. For example, here, if I just take a look, 100 is the amount, interest is 10, and my cumulative amount at the end of year 1 is 110. Now, if I go to the same thing, it's 100, and then interest is 10 rupees, and then my cumulative amount is not 110, it is basically 120. So here there is a small error. So the cumulative amount is 120. So effectively the concept remains the same, that my principal is still the same of 100, yet my interest is computed at the rate of 10% on my base principal amount. Now, is that the same with compound interest? No. What differentiates the simple interest from compound interest is the manner in which the interest rate is computed and the principal, what is taken as the base. So here 100 turns into 110 at the end of year 1. Now, it will not turn to 120 at the end of year 2 as in case of simple interest, but it turns to 121, and it turns to 133, it turns to 146. So what is happening here? So what is happening here is, when at the end of year 0, I'm taking 100 as the initial amount, interest is being calculated on the same amount of 100, like in case of simple interest, and my cumulative amount would be 110. Now in the second year, this is what makes the difference in between simple interest and compound interest. In the second year, when I am taking up the principal for computational purposes, it is not the 100 like in case of simple interest what I'm considering, but it is 110. That is the accumulation of 10% on account of interest is also being considered for computing the compound interest for year 2. Also, if I go for third year, the interest accrued in year 1 of 10 rupees and year 2 in 11 rupees is also being considered as principal, and then 10% of the cumulative amount is being added, and then we are arriving at 133, and so on and so on. Now effectively you might ask, how much is the interest difference that is happening? Now the interest difference is 50 rupees in case of a simple interest, whereas I'm getting a interest of 61 rupees in compound interest. This is where the concept of compound interest plays an important role. So the power of compounding is the 8th wonder in the world, as rightly told. So this is what illustrates that 50 is where you are getting the amount of interest in case of simple interest, whereas it is 61. Now that's a huge difference of 11 rupees. 11 rupees is what the difference what you're getting, when I compare simple interest and compound interest. So how do we put it in terms of a simple formula, present value and future value? So for example, let's take it with the help of an example. Now continuing the present example, now how did I get 110? 110 is 100 is the principal amount, 1 plus r by 100. Now that is simply 1 plus 10 by 100. I'm going to get 110. Now for year 2, I am going to get 110 plus 10% of 110. That is nothing but 121. Now 121 will become my capital base or the principal base for year 3. And now my principal amount at the end of year 3 would be 121 into, or 121 plus 121 into 10 by 100. That is nothing but 133, and so on. This is how we are arriving at. Now, do we have so much time to deal with this kind of a problem? For example, not the typical problem what the CFNL exam tests us. At least for this kind of a problem, do we have so much time? We don't have so much time. So how do we solve this? Simply with the help of an example. So let's try to understand it in a much logical manner rather than trying to go with rote learning, which we would never prefer for. So what is the logic? What is the driving derivation driving behind this thing? I'll put it simply. 100 is your principal. Now I'm going to multiply it with 1.1. What is 1.1? 1.1 is nothing but your interest. So 1 plus 10 by 100. 10 is my rate of interest. So 1 plus 10 by 100 is 110 by 100. And that is nothing but 1.1. So 1.1 I'm going to multiply with 100, and then I'm going to arrive at the future value at the end of year 1. And if I go to year 2, now 110 is being multiplied again with 1.1. If I go to year 3, 121 is being multiplied with 1.1. So I have put it simply that 100 into 1.1 into 1.1 into 1.1 into 1.1 and so on for the n number of years, how many ever you have. Now in our case it is for 5 years. I'm going to multiply 100 with 1.1 5 times. Now I'm going to get anyways 161 at the end of year 5. So instead I can just do it 100 into 1.1 whole to the power of 5, because anyways I am multiplying 1.1 5 times. Now this can be simply put as 100 into 1.1 whole to the power of 5. And how do we write 1.1 in a much better manner? So for a layman to understand 1.1, people might ask us, what is 1.1 and how did we arrive at? Now 1.1, we can put it in a much understandable manner by 100 into 1 plus 10 by 100. Now this gives us 110 by 100. That is nothing but 1.1. So 100 into 1.1 whole to the power of 5. Alternatively, 100, that is nothing but the principal, into 1 plus 10. 10 is nothing but the rate of interest. So 100 P into 1 plus 10. 10 is the R. 1 plus R by 100 whole to the power of 5. 5 is nothing but my term or the period. So this is how the derivation goes. So any SFM problem, any formula, whatever we are trying to apply in SFM, not just for time value of money or per se or any other chapter, we are going to dissect and learn how exactly the formula, the rationale behind the formula works. So the future value comes to be P into 1 plus R by 100 whole to the power of N. Now what is the present value? Put simply, you would be aware of the elementary mathematics wherein present value is nothing but future value divided by P into 1 plus R by 100 whole to the power of N. Now this P into 1 plus R by 100 whole to the power of N would come to the left side and then fall in the denominator of future value. So your present value would be future value divided by 1 plus R by 100 whole to the power of N.